Hi, good evening, everyone, and wish you a very good morning to David and all the other friends who have joined in from other parts of the world. Uh, it's my honor and privilege to be here on behalf of the CFA Society India to welcome all of you to this very interesting session today on how fundamentally minded investors use technical analysis. Uh, Very quickly, to give you a brief introduction of myself, some of you already know me, but for all others, my name is Anil Gelani. I'm going to be the moderator for today's session. Currently, I am associated with the CFA Society India in my volunteer capacity as the vice chairman. And as a part of my day job, I work in Mumbai, India, with an asset management firm called DSP Investment Managers, where I am heading the passive investments team over here. It's my privilege today to host David for a very interesting session. And before I start off the session, I would just like to highlight one interesting discussion that we were having and trying to lead towards how people actually use decision making in your day-to-day lives. So, we were just chatting, and I mentioned to a friend of mine that after all the lockdown and all opens, I will love next time in your visit to Mumbai, David, to host you in my office in Mumbai, and let's say in the month of January when you come down. So just to keep it ready and prepare myself for it, would you like me to keep some hot beverages for you, like a coffee, tea, or would you like to have some fresh juice, like cool fresh juice? So now for David to make that decision, he was a little bit confused that I don't know in Mumbai in the month of January which fresh fruit might be available and whether it will be a climate which is cold, or I would like to prefer like a hot coffee to keep me active. So rather than taking a decision using or, in the sense like coffee or juice, he said, let me take a decision using and. So I will have coffee and a fresh cold juice as well. So sometimes using and versus or in any decision making, even in your day-to-day life, can actually be very powerful for your judgment and for your decision making. And very similar to that, friends, when we talk about decision making in the world of investing, even at that point of time, very often people do ask that, are you using some fundamental techniques or you believe in technical analysis? So I always try to believe that why not use the power of and in decision making, even for investments, and try to use both fundamental research and technical analysis to give you a much more better power of making investment decisions. So with that background itself, I would like to open up the session and introduce to you Mr. David Lundgren. David is a very senior market practitioner, and currently he is the head of technical research at Wellington Management. And David currently looks after various global equity indices and equity as an asset class, as well as FICC, like fixed income, currency, and commodities. And he has a very robust and rich, diverse background. As you can see from his uh, uh, education background, he's a CFA charter holder as well as a member of the CMT. So in his work area, he has very well identified the formula of aligning both fundamentals as well as technicals. And today we are privileged to hear from David in terms of how he does the combination and how people who are having a fundamental approach can use technical analysis to uncover some hidden opportunities in investments, whether it's in the form of equities or any other asset class. Just 30 seconds more before I hand over to David, to all my participants on the webinar today. We will structure this in a fashion where we have about 1 hour of the entire session, and towards the end we will have a Q&A. So I urge all of you that as the session goes on and David is expressing his views, please keep noting down whatever thoughts or questions that come to your mind and keep posting them in the chat window at the bottom of your screen. You might be seeing a chat window for posting questions. So those questions will keep coming up to me, and towards the end, we'll have a very interesting and engaging Q&A session. And my sincere request is that after the session, spare another 30 seconds before you log off my colleague will be sharing a link for feedback, because it's very important for us to get feedback of the session, of various aspects of the session, so as to keep improvising further. So do spare a few minutes for that. And yes, of course, the slides which David will be using will also be available just after the session. So a link for that also will be shared with all of you. So with that, I think once again, thank you all for joining this very interesting session. Wherever you are, in whichever part of the world, wish you a very warm welcome. And over to you, David. We are very much looking forward and eager to hear your views.
Thank you so much, Anil. Can you hear me okay? Excellent,
yes,
great. Wonderful, thank you. And I hope this session finds everybody healthy and navigating these crazy times that we're experiencing around the globe. I hope all is well. What we're going to, I have a few goals for today. Anil lined it up pretty well for us. We're going to try to identify and draw the connections and links between fundamentals and technicals. There's this long-standing sort of debate as to what's the right way to look at the world. Is it technically or is it fundamentally? And what I hope to demonstrate is that there's actually a number of underappreciated connections between technical and fundamental investing. In many ways, they're the same thing, just done differently. So we'll talk about that. I'd also like to talk about building the case for why fundamental investors should consider using technical analysis as part of their process, be it for risk management, big picture sort of macro analysis, and idea generation. These are areas that we often find are lacking and difficult to accomplish within fundamental investing, risk management, and big picture analysis and things like that. And we find that technical analysis can really fill that void. So we'll talk about that. And then we'll also just go through some examples of how fundamental investors have used and do use technical analysis today to help make them better stock pickers or portfolio managers. And so the idea is not about replacing your fundamental analysis with technicals. It's just coming together and using them together to augment and to allow each of those two styles to benefit from each other. And so we'll spend a lot of time on that today. And then we'll open it up for Q&A as we go. So let's jump right in here. I want to begin by just touching upon the two more prominent sort of philosophies that underpin the fundamental investment philosophy. And of course, we know the random walk hypothesis is probably one of the leading philosophies of the fundamental philosophy. And so there are many people we can highlight that over the years have contributed to this body of knowledge in the random walk hypothesis. Here are a couple spanning from 1900 to 1973. Both very good reads if you haven't read each of these yet. But in essence, the notion is that the market is random in that there's no memory in the market. So the market doesn't remember what happened yesterday, and it's not influenced by what happens today. And so to summarize, it's basically to say that today's price action is not influenced by yesterday's price action. They're independent of each other, much like how one roll of a dice does not influence the next roll. And therein lies the random nature of the market. And we can also say that today's price action or dice roll won't influence tomorrow's price action. So they're independent of each other. And what I roll as a participant in the game doesn't influence what you roll, and vice versa. So what you roll doesn't change what I roll. So that's the whole notion of random walk, is that these things they're not linked and they're independent of each other. And as a result of that, what we find is that price action is normally distributed like rolls of a dice. That's what that's sort of the notion that underpins this the random walk hypothesis. Now, what's interesting about this, and I think is pretty insightful to think, is to highlight is Paul Samuelson, who's one of the more prominent, well-known economists of our time, wrote the economics, the textbook Economics in 1948. It's still considered one of the best textbooks on the subject available. In Paul Samuelson, of course, is a big proponent of the random walk hypothesis and the emergent market, the efficient market hypothesis as well. And despite that, in his textbook, he says himself that the most wonderful thing about a bull market is that it creates its own hopes. If people buy because they think stocks will rise, their active buying sends up the price of stocks. This causes them to buy still further and sends the dizzy dance off on another round. So here is evidence of a prominent random walk adherent struggling with the idea that the market actually is random, because we can see that the market does go on these trends that are behaviorally driven, and very much what happens yesterday affects what I do today, and what I do today does affect what happens tomorrow. And so here's a very prominent thinker in this field struggling with the notion that the market actually is random. And I think that's probably worth pointing out. So let's talk about the efficient market hypothesis. I'm sure you're familiar with this as well. Of course, Eugene Fama is front and center in terms of its formation and evolution. We know that there are three forms to the efficient market hypothesis. We have the weak form, which says that you cannot use historical price or historical information to beat the market. So prices already reflect all past publicly available information. Now, of course, there are many academic studies and ample empirical results that show that momentum can indeed be used to beat the market, not the least of which comes from Jim Simons, who's from Renaissance Technology, who's one of the, if not the greatest hedge fund manager of all time. He's certainly among the elite, and he himself says that past performance is the best predictor of success. And so if I have to lean on this theory that the market's efficient and you can't use historical price data to beat the market, or the word of Jim Simons, I think I'll take the word of Jim here. Semi-strong, we're familiar with, is also says that prices also automatically adjust to reflect new information as it comes out. Of course, an entire field of the investment science has developed around this notion. It's called behavioral finance, and because of the behavioral biases, we as investors have difficulty responding in live time with the new information as it becomes available because of these behavioral biases. And so none other than Charlie Munger from Berkshire Hathaway, partner with Warren Buffett, says himself, your mistaken professors were too much influenced by rational man models of human behavior from economics, and too little by foolish man models from psychology in real world experience. So here's a very successful, fundamentally minded investor making a note that that human behavior prevents us from being rational. And again, I'll take the word of Charlie Munger on that. Lastly, of course, we have the strong form, which says that prices also reflect all insider information. So you can't use inside information to beat the market. Now that's plain silly. We can probably all agree that that if I were to start a hedge fund today and I could use only insider information, you can rest assured I can absolutely beat the market. I might go to jail, but I can certainly beat the market. So the idea is that you can't beat the market using insider information, but that's only because it's illegal, right? So those are the two more prominent philosophies that underpin the fundamental investment process. And I would just probably highlight, as it relates to the weak form efficiency, we're all probably familiar with the long-term study that's been done on momentum factor, going back to 1927. If we just take in decile momentum, looking back over 12 months, and just put the market's momentum into 10 deciles, what we find is that over time, the stocks with the best 12-month momentum do the best going forward, and the stocks with the worst 12-month momentum do the worst going forward. So there's ample academic and empirical proof to demonstrate that you can indeed use past historical information to beat the market. And I think this is something that's come to light, and I think we are more and more coming around to this notion that technical and momentum type inputs can be very helpful for you as an investor and warrant consideration in your investment process. So we're familiar with those two philosophies. Preceding those two philosophies by about 50 years, actually, is what we in the technical community call the Dow Theory. This is how we think about the market. And what you'll come to realize is that as I explain this to you, you'll come to realize that we're actually saying the same thing. And that's my point here, is that philosophically, when we each from our different camps of investing talk about how we think about what drives markets, we realize that we're all saying the same thing. So Charles Dow was the founder of the Dow Jones Company, which later went on to publish the Wall Street Journal. So Charles Dow was the founder and editor of the journal. So he's a very fundamentally minded and economically savvy investor, very noted investor of his day. but he was also very mindful of the importance of the message of the market and listening to what the market was trying to say. And so what he would actually do back in the late 1800s is he would write an editorial in the Wall Street Journal in which he would talk only about the technical nature of the market and his technical philosophy about how to read the message of the market and interpret the message of the market and use that to make yourself a better fundamental investor. And he would write these editorials up until the past, and then William Peter Hamilton then assumed the role of editor of the Wall Street Journal and continued to write these very same technically oriented editorials in the Wall Street Journal. And he actually later wrote the book called Stock Market Barometer, which is also a fantastic book. And it was his effort to sort of codify what later became known as the Dow Theory, which was finally done by a gentleman named Robert Ray. He wrote a book called the Dow Theory, and so up until that moment, it wasn't actually referred to as the Dow Theory. But when Mr. Ray wrote this book, he really well articulated the principles that Charles Dow and William Peter Hamilton laid out in these editorials in the Wall Street Journal, and he called his book the Dow Theory. And so from that point forward, it was come to be known as the Dow Theory. So Charles Dow, what he believed was that the market moves in three movements. It has three sort of time frames: these long-term, medium-term, and short-term. And he referred to them as tides, waves, and ripples. So he used this analogy of the water moving and sloshing around on the surface of the ocean to demonstrate the difference in time frame of the movement of the market, as well as the difference in its importance. So he would refer to the primary trend as that long-term trend, and he referred to that as the tide. So if you can imagine that the more significant movements of the water around the surface of the earth, these are the major long-term price trends, and they're driven by actual fundamentals. So if a company has good, strong fundamentals over time, Charles Dow would argue that price would go up over time. And if the fundamentals were bad, the price would go down over time. And importantly, that trend is not, you cannot manipulate that trend. So we have some very prominent examples of that today. We have in Japan, where the fundamentals have been struggling for about 30 years. That market has gone nowhere for 30 years. That primary trend has gone nowhere for 30 years, and that's despite all the efforts that have been put forth by the central bank to engage a bull market in Japan. And the reason, despite the unlimited checkbook of the central bank in Japan, despite all their efforts, they still can't turn the tide there because the fundamentals are bearish. We can also point to Tesla today. There are more people that want to be short that stock because they believe the fundamentals. They believe it's a scam, and it's not a fundamentally sound company, and the premise of how he's conducting his business is not fundamentally sound, and so there's a lot of short exposure in that stock. But look at what that stock keeps doing. That primary trend is moving higher because the fundamentals, the message of the market, in the ultimate distillation of all this fundamental data, the price is up. That primary trend is up, and that would be the market's way of telling you that the fundamentals for that company are very strong. So we have very good examples of that today. The secondary trend, which Charles Dow referred to as the waves. So think about the more intermediate time frame of movements of water along the surface of those shifting tides. These are driven by both the fundamentals, which would be the signal, and the emotions or the emotional response to those fundamentals, which would be the noise. These can last for years, for months, if not years, and they can be manipulated, even if only because of, say, a large shareholder in Tesla decides that they want to liquidate their position. That alone, just that liquidation of that position, could temporarily manipulate or cause that trend to veer its course for a moment. But again, it will realign itself with the fundamentals and continue on its way. And then thirdly, there's the minor trend, which Charles Dow referred to as the ripples, which is, you just think about these droplets of water flickering along the surface of the waves and the tide. These trends are very short-term, driven almost entirely by emotional response to the fundamentals. And they last for days or weeks. They're very short-term, and they absolutely are able to be manipulated. We see hedge funds posting tweets and things like that, trying to encourage folks to get short Tesla and things like that, and there is an emotional response to those news items. But again, those are very short-term aberrations in an ongoing primary trend, which is ultimately driven by the fundamentals. So again, ahead of his time, Dow, 50 years before, was really well articulated in the fundamental community. Dow recognized that the market was both random and efficient. The idea being that prices become more random as your time horizon shrinks, so there's more noise and less signal, and more efficient as your time horizon extends. So you can see that philosophically, the way that the technical community thinks about what drives price over time, it's virtually the same thing as what was articulated by others in the fundamental community 50 years later. So we're thinking from the same we're playing from the same playbook, if you will. So we have, of course, Paul Samuelson and Benjamin Graham, who are two prominent thinkers in the fundamental community, and it's a couple of interesting quotes from each of them make you wonder if they weren't secretly Dow theorists. Paul Samuelson, once again, in his excellent textbook, Economics, in 1948, he wrote, "The ideal competitive market is characterized by an equilibrium that is constantly being disturbed, but is always in the process of reforming itself." And then I add this emphasis, not unlike the surface of the ocean. That's almost verbatim what Charles Dow said 50 years before. And then we have Benjamin Graham using another analogy to basically make the same point. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. Again, reiterating what Charles Dow had said 50 years before. So two very prominent investors in the fundamental space, basically saying the same thing that Charles Dow said 50 years before. So I'm once again just trying to make the point that we all agree. In the short term, these ripples and waves, the market is very noisy as investors respond emotionally to these fundamentals. But in the long term, that the tide, if you will, the market is remarkably efficient at reflecting actual fundamentals, regardless of the short-term behavioral biases that may exist from point to point. So again, the point here being that we're very much aligned in how we think about what drives the market. So philosophically, we agree. It's just that there's philosophy and then there's process. So the process is what you do as an investor to implement that philosophy. So although we share the same philosophy, it's just that we have a different process to reflect that philosophy in the market. And we'll talk about what that process is and how fundamental investors can continue using their own philosophy, or their own process to reflect their philosophy, but can also lean on some of these tools in the technical space to help them better their stock selection or their risk management or idea generation or whatever that may be. So one thing I want to point out is this unbreakable link between fundamentals and trends. So again, there's this long-standing debate as to what's the right way to think about the market. Is it fundamentals or is it trend? I would make the case that these things are joined at the hip. They're inseparable. And the way I would do that is to just demonstrate there's basically three ways you can invest. There's price, which is how I invest, using price alone, momentum, technical analysis. There's growth, and then there's value. And again, if you think about the way each of these investors go about their business, if you will, they seem really disparate and disconnected from each other. But the point I would make is that they're actually very connected. In fact, they're in the same exact formula. So price is equal to the earnings per share times value. So they're literally linked with each other. And you can take it even one step further and say that the right side of this formula also is highly influenced by behavioral bias, right? So in summary, you can say that price is simply earnings per share or growth times the PE ratio or V, both of which are influenced by behavioral bias, depending on where we are in the cycle. So there's either a lot of optimism, and so the growth estimates are really high, and valuations being assigned to that growth are very high valuations, or we're in a down cycle and the growth estimates are low and the valuations being assigned are very low. So behavioral bias plays a very important role here as well. But the point is, you can look at this formula and come to realize and appreciate how linked all of these styles are, as disparate and disconnected as they may seem to be. So the point is that we're all in this together. Each side of this formula needs cooperation from the other side of the formula to make money. Nobody makes money unless we all make money, right? So the right side of this formula does not make money unless it gets cooperation from the left side, unless price actually starts to go up. Conversely stated, me as a technician, me as a trend follower operating on the left side of the formula, I don't make any money unless the growth starts to go up, unless valuation starts to expand, or preferably both. That's when you get your really big home run ideas, strong growth with expanding valuation. But the point is that because we're all operating from the same formula, we're all in this together. And so although it's a similar formula, there are some differences to consider. And these are important because they enable you to determine as an investor where you should engage in this formula, right? So there's a large degree of complexity on the right side of the formula. So when you click on that G, for instance, what you end up doing is you end up opening this Pandora's box of questions that you have to answer as a growth investor. Are we talking about growth in earnings per share? Or are we talking about, we talk about share repurchases? Are they issuing stock? Are we talking about revenue growth, unit growth, changes in management, changes in government policy, shifts in the strategic landscape for this company? There are many different aspects in questions that need to be answered as a growth investor. And as soon as you click on that G, it opens this full array of questions. That same degree of complexity exists on the V. As soon as you click on that V, you open this entire decision tree of different types of valuation metrics you have to address. Are we talking about price to earnings, price to book value, price to cash flow? And when we're talking about cash flow, do you define cash flow the same way I define cash flow? Is it different? Are we talking about relative valuation? Relative to what? Relative to its own history, relative to its peers, relative to the market, relative to another asset class? Are we comparing the earnings yield to the bond yield? So all these questions, as soon as you click on each one of these components on that side of the formula, all these questions need to be answered, right? So it's a very complex set of decisions that need to be made. And on the left side of the formula, when you click on that P, price, what you get is, well, price. It doesn't change. It never does. Price, and this is the true value of technical analysis. Price is an incredibly efficient mechanism for distilling all the complexity on the right side of that formula into one single observation. And the ability to use that output from the market to help guide your decisions that you make on the right-hand side of this formula, I think is something that's underappreciated. And I hope that as we go through this discussion today, you can get a better sense for how the simplicity that exists on the left side of this formula is something that you can really truly leverage as an investor operating on the right side of the formula. So that's another point, is this difference in perspective for each investor operating on each side of this formula. So if you come to work every day operating on the right side of this formula, you literally come to work each day with the belief that the market is wrong and you are right. Like, I believe growth is going to be 30% per year and the market only thinks 20%. So I think that the market is wrong, and so therefore I'm going to buy this stock because of that difference in the value of the company. Conversely, or alternatively, you might come in as a value manager and say, I think that this company is worth 10 times earnings and it's trading at 17 times earnings, and so therefore I'm going to short it. Right? So you're always looking for this disconnect between what you think and what the market thinks, because you believe in these instances the market is wrong. If you come to work every day operating on the left side of the formula, like I do, I come to the office every day operating on the base case assumption that the market is right, that what's happening in the market should be happening. And in the infinite wisdom of the market and all these really smart decisions that are being made on the right side of the formula, that simple distillation that comes out in price, that is the right number. And so I come to work every day with the belief that the market is right. Those two perspectives are completely opposite ends of the spectrum from each other. And so it's not a question of which one is right or which one is wrong. It's about getting to know yourself. This is a really important point, is getting to know yourself as an investor and then determining where you should engage in this formula as an investor, because all three of these styles through time, they do very well over time, but they also have their periods of drawdowns. And so what you cannot do as an investor is say, come into the, raise assets with an investor and say, I'm a growth investor, and then go through a period of drawdown because growth isn't working, and then switch to becoming a value investor, and then go try to explain that to the investors in your fund. That's not going to happen. You're going to lose all your assets, right? So you have to determine which part of this formula can I engage with, where I've really philosophically am firmly rooted in what is required to be a good growth manager or a value manager or price manager, because there are going to be times when it's going to be very difficult to be that investor, and you need to see yourself through, because you're not going to be able to just jump from horse to horse in the middle of the river as the conditions change. So Adam Smith and The Money Game, which is another fantastic, highly recommended book if you hadn't read it. In that book, he says, if you don't know who you are, this, meaning the stock market, is an expensive place to find out. So it's not about who's right or wrong. It's about figuring out who you are as an investor and where you want to engage in this formula, and then use the other inputs from the remaining part of the formula to help you fill in the gaps of your process that you choose. And again, I would argue that the technical strategy does a great job of filling in a lot of the gaps that exist on the right-hand side of this formula. So why would a fundamental investor follow price? And I think the arguments can be made pretty clearly. No matter what your personal views are of growth or value on the right side of the formula, you will never make money until the market, P, agrees with you. Until the stock starts to trend, your opinion will not result in a profitable trade for you. If agreement means a strong trend or price, then why not pay attention to price? So in the end, we agree on the importance of fundamentals. We all agree with that. The way to think about what a technician, how does a technician link his process with the fundamentals that drive those prices? It's simple. Technicians have simply hired the market to conduct their fundamental analysis for them. I think we can all agree that if you look over through time, the market has proven itself to be very difficult to beat. The reason it's very difficult to beat is because it's a very good fundamental analyst, better than anybody on the planet over time for sure. So what we have done as technicians is we've just handed over those reins of the fundamental analysis to the market. And I meet with my fundamental analyst every morning, the market. In that market, my analyst gives me the best fundamental ideas that I should be considering for my portfolios every single day. So it's not that I don't believe in fundamentals. There's nobody on this planet who believes in fundamentals more than I do. It's just that what I've come to learn over time, and I think you'll all agree, is that the market is a very good fundamental analyst. So I've just chosen to listen, and I interpret that message vis-a-vis that very simple distillation, which we call price, on the left side of this formula. This is an important point. In the end, no matter who you are, even if you're a value manager, you are a trend follower. Regardless of why you buy a stock, you need price to trend higher after you buy it. And of course, the sooner the better. So let me illustrate this. So if we were to take price, which we know is like if it's an uptrend, and we were to detrend it and sort of put it on a sine wave, it would look like this. And so this would be the mean of the trend, or the average of the trend. Maybe think about it as the 200-day average. Anything down below the mean, of course, is a bearish trend, and anything above the mean is a bullish trend. This part of the trend is what we're all trying to capture. I don't care if you're a value manager, a growth manager, like me, a price momentum technical manager, or if we were talking earlier before the session began, a quant manager who kind of pulls all this together and does it with the computers, even a quant manager or a macro strategist, whoever you are, all of us are trying to capture the same trend. Nobody is trying to purposefully buy stocks right before they go down, right? Nobody's trying to do that. We're all trying to capture the same exact trend, and it turns out that this part of the trend is driven by strong and improving fundamentals. Now, over here we have poor fundamentals, and over here we have weakening fundamentals, and so those two are associated with either very weak price action or deteriorating price action. And again, nobody wants to be involved in those situations. We want to be involved in the middle meat of that trend, if you will. So a value manager will start to buy here. So start to buy when the stock is cheap, even when the fundamentals are poor, on the assumption that the stock is so cheap that I can afford to wait for the fundamentals to get better. And they'll continue to buy all the way down. And then conversely, as the stock begins to work and the fundamentals start to get better, value managers will start to sell here as the stock gets more and more expensive. As a result of this, value managers begin buying early, and they expose themselves to large sort of left tail events, if you will. They begin selling early, and as a result of that, they forego these large gains that could actually accrue to them had they stuck with the stock a little bit longer instead of selling when they thought the stock was expensive. Conversely, a trend follower starts to buy here, only because of the inflection in trend, not because of the improving fundamentals, but only because of that inflection in trend, right? And trend followers begin to sell here when the trend begins to deteriorate, not when the fundamentals begin to deteriorate, but when the trend does. And as I said, those two things are linked, as I showed you earlier in that formula. If the fundamentals begin to deteriorate, P will come down, right? So that's reflected in price. But as a result of our strategy, what we find is that trend followers begin to buy late. We never buy the low. And we begin to sell late. We never sell the high. Our goal is to capture the bulk of that trend in the middle. And that therein lies the difference. So the change in fundamentals is the catalyst that unlocks those undervalued and overvalued situations. So these stocks can remain cheap for very long periods of time. And that cheapness or that cheap valuation doesn't get unlocked until the fundamentals begin to improve. Trend change is the confirmation that the fundamentals are improving. So if you have a fundamental view on a stock and it still has poor technicals, what I would encourage you to do is to wait for that trend to change. And we'll show you some simple measurements on how to do that in a moment. But this is the power of bringing these together. We're all trying to capture the same trend. So I encourage you to listen to price and really place your bets and make them bigger when the trend is in your favor. So this is what it takes to successfully follow the trend. So here's 3 quotes from 3 very successful investors over 3 centuries of investing. They're all 3 prominent, fundamental, economically minded investors. None of these are technicians, except for maybe Bill Eckhart on the end there, I'm sorry. But they're all prominent, very successful investors stretching over 3 centuries of investing. And if you read each quote, they're all saying the same thing. Cut your losses short and let your profits run. And this is just 3 of many, many examples of very successful investors through time who have said the very same thing. So this is what it looks like when you do this in practice. So if you were to take a frequency diagram and we were to map all of our trades to this diagram where we would have our losses on the left side, and we would just continue to do this as you close out each trade, and you just continue to fill in this frequency diagram. What you'll notice is that there's an accumulation of losses on the left-hand side. There's a lot of losses as a trend follower. But you'll notice all of the losses on the left are small because we manage our risk. All of the losses just pile up in a very concerted, very concentrated area on this frequency diagram. And we just continue with the process, and you end up with a diagram that looks like this. And so you have a lot of small losses on the left-hand side, and then you have not as many, but a lot of wins on the right, but you have a lot of outliers on the right-hand side of this diagram. So the idea is that you have these big wins that pay for all those small losses. And we'll get to the importance in a moment of the importance of managing your risk like this as a trend follower. This is where, if you think about fundamental and value investing, this is, to me, one of the biggest holes in those 2 strategies, is that there is no way to really truly manage your risk in a way that reflects what's happening in the market. Oftentimes, by the time you decide to sell something as a growth investor, the stock has already gone down a lot. Or by the time you buy something as a value manager, the stock hasn't even turned yet. So as a result of that, you end up with this hole in your process that prevents you from being able to manage your risk. That's a critical part over time to building a strong track record as an investor, which we'll get to in a moment. But when you go through this process and you end up with a diagram like this, if I were to simplify it, we're all familiar with a frequency diagram that looks like this. And we refer to it as positive skew. This positive skew is a direct result of cutting your losses short and letting your profits run. And in an instance like this, where as a trend follower, as any kind of investor, if you're right half the time, you're actually a pretty good investor. In any given year, if half your portfolio outperforms the benchmark, you're actually doing quite well. So in this case here, we're wrong 60% of the time. But the concept of expectancy is this: if you lose 60% of the time, but your average gain is 2 to 3 times bigger than your average loss, you win, right? So that's the whole notion of cut your losses short and let your profits run, and that's the benefit of the benefit of overlaying a trend following technical analysis approach to your fundamental investment process. So the idea is to dig small holes when you're wrong, and this is how technical analysis can help, I should say the effect of using technical analysis to help you dig small holes can have on your long-term record. So I'm sure we've seen this analogy before, but if you begin with $100 and it declines 50%, from there you have to go up 100% to get back to break even. Now I'm sure we've all seen this before, but this is what stop placement is all about. It's what risk management is all about. It's about avoiding these large holes that you then have to dig out of over time. And as an investor, it's painful to have to do that. But as an investor in a fund that goes down 50%, that then has to come back 100% to get back to break even, is even more painful. So if you can't manage your risk on the downside, not only is it difficult to do as an investor, but it's difficult to run a business that way as well, because investors won't stick with you. And I'll show you that in a moment. But the idea is that this is all hinges on this fallacy of it can't go much lower. And so when we look at, like, for an example, if a stock goes down 90%, what's another 5%, right? It's only 5% more. When in reality, what we lose sight of, it's actually 50% more. And it's always can go down another 50% no matter how low a stock goes. And so if you don't manage your risk and get out of a stock when you've been proven wrong vis-a-vis price, which is the left side of that formula, which is very much connected with the right side of the formula, if you ignore that, then this is what you expose yourself to. So here's an example of a very spectacular, successful investor. This is not something this is not an actual example. And in fact, it's almost perhaps unattainable for us to try to aspire to. But I want to use this as a base case to show you what can happen to a phenomenal track record if you don't manage your risk. So this is 10 years of history. You can see 20 to 30% returns each year. There are no down years. And over the 10 years, it works out to a 23% compound annual growth rate. If you take that same exact investor and just give him, coming out of the gate, one bad year, everything else is spectacular. Same investor, just one bad year, and in that first year, he's down 50% because he didn't manage his risk. It's going to take that investor 4 years to get back to break even. And the net effect of that 50% decline coming out of the gate is a significant difference in the compound growth of that investor's portfolio. It's almost half, right? Big difference. Something a little bit more reasonable and attainable for us as investors is 7 years of positive performance and 3 years of negative performance. That's something that's probably more in the realm of reality. But look what happens if you don't manage your risk during these bad years. You have great, spectacular up years, very similar to what you see in the first two examples. But when you're down, call it too much. The net effect on that return is 7% a compound over that 10-year period. So the consequence of digging these big holes is that it ends up dragging your long-term performance down quite a bit because you're constantly digging out of these big holes. And then a more, I think, achievable result, if you combine strong fundamental analysis with potent risk management, is more agreeable down years. And as a consequence of wrapping your process with a risk overlay, if you will, a trend following risk overlay, using stops, in other words, is that you'll find that you'll end up giving up some of the upside as well. So this is, you'll see, going from 30% to 28% as a consequence of taking less risk. So we know this notion that the less risk you take, the less returns, right? So if we adjust these returns for both risk and return, you end up with a return that's 12%. So in the end, what you end up with is returns over a 10 and 20-year period, comparing 7 to 12%, the latter two examples, you end up with better returns with lower volatility. So as an investor, it's more likely that you as an investor will be able to implement a strategy like that. But importantly, we can't forget that as portfolio managers, we're also in business, right? And we're trying to raise assets, and we're trying to get investors to have confidence to put money in our fundamental approaches. But if we can't deliver that in a way that they can sit through it as investors, then it's all for nothing, right? So the idea is to have better returns with lower volatility, because you can also build a business that way. So as George Soros himself, one of the great investors of our time, clearly one of the best macro investors, and by the way, a very technically aware investor, Stanley Druckenmiller, who's a very prominent fundamental investor, came from the Quantum Fund with George Soros. Stanley Druckenmiller is a very very heavy user of charts and technical analysis. George Soros says that it's not whether you're right or wrong that's important, but how much you make when you're right and how much you lose when you're wrong. And given his long-term track record, once again, here's an example of somebody's advice I'm very willing to take. Okay, moving along, let's talk about how we can get some of these trend-following techniques implemented into our fundamental approach. So there are some inviolable rules of trend following. So in this quote here from Richard Kraut in Aristotle's Ethics, he says that although Aristotle holds that ethics cannot be reduced to a system of rules, however complex, he insists that some rules are inviolable. So there are some things about life that are just inviolable. They just are what they are. I think investing is a lot like that. I think there are a lot of things about investing that are just, there's too many moving parts to really nail it down to a bunch of rules. So a stock can go up for a lot of different reasons. It could be margin expansion, earnings growth, new management, something happening with government regulation. All these things can come into play to make a stock go up. And so it's really hard to wrap those potential outcomes in a set of rules that you can rely upon with any degree of regularity. But in technical analysis, there are rules that you can lean on that must happen. They're inviolable. These things must happen for a stock to go from down to up and from up to down. For a stock to go up a lot, these four things must happen. For a stock to go down a lot, these four things must happen. They're inviolable. I refer to these as the checklist of trend change. And these four things, absolutely, they're unavoidable. They must happen in order for a stock to do well or for a stock to do poorly. So let's begin with the list here. So the first box is you have to break the trend, right? So a trend line is simply a line that you draw off the bottom of the trend to indicate that the trend has changed should it be broken. So here we have the break of the trend. Secondarily, you need to break the last swing low of that uptrend. So I have this horizontal line drawn at the last swing low of the uptrend. Here we break that swing low. That's the second box of the checklist. So now we have very strong confirmation that the trend is beginning to reverse. And then in the lagging nature, oftentimes we find that when the 50-day average crosses the 200-day average, you have your third confirmation. And this stock, mathematically, think about how moving averages are calculated. A stock or a market or the price of oil or the price of gold, the price of used cars, price of collectible artwork cannot go up or down a lot unless the 50-day average crosses the 200-day average. It's virtually mathematically impossible. So this is an inviolable rule. And then lastly, that long-term average will turn down, thereby checking the fourth box. So if you're a fundamental investor and you love this company and you've been able to check all four of these boxes, what I would advocate is that you sell the stock and just come back to it later when you can start checking boxes in the other direction again. And then stay with that trend until you can start checking boxes in the other direction again. This is the idea. This is how you can lean on trend following principles to help make you a better, not so much a better fundamental investor, but a better market timer or timer of your position sizing, a better portfolio manager, et cetera, by leaning on these inviolable rules that must happen in order for you to make money on the ideas that you've determined are worthy of taking risks on from a fundamental perspective. So going back to this formula that we talked about earlier, this is how you might see a fundamental investor use this checklist of trend change and trend following to guide them in and out of a stock that they may fundamentally like over time. So this is a stock of Home Depot, and you can see it had a very strong run from 1990 to 1993, and with that came some very strong relative performance. So relative performance is simply taking the price of the stock and dividing it by the market. So there's a ratio there. And if they're both going up, but the price of the stock is getting bigger faster than the price of the market, that relative performance line is going to rise. So when you see a rising relative performance line, it tells you that whatever the stock is doing, it's doing better than the market, right? So if you look at this performance, you can probably well imagine, based on the unavoidable consequence of this formula, price went up a lot. So something really good must have happened on the right side of this formula. And rest assured, something did. If you look at the growth of this company, the revenues went up 186%. The EBITDA went up 210%. Margins expanded 100 basis points. And the valuation went up almost 400%. It went from price to sales, went from about 1 times sales to 4 times sales. And the PE ratio went up 300%. Went from 28 times earnings to 85 times earnings, right? So That's quite a contribution on the right-hand side of that formula from all three parts of that formula: growth, value, and behavioral bias, right? The amount that you're willing to pay for these earnings expanded 400%. And then we go through this period where the stock goes down, and there's a 4-year run of very strong, very weak relative performance, I should say. And you can imagine, it's unviable. This is another unviable rule. This formula is linked. So if price did what it did, it's probably because the fundamentals were terrible during that period, right? I mean, that's a fair assumption. When we look at it, however, what we come to realize is that the revenues during this 4-year period of very poor performance, the revenues went up 240%. The EBITDA went up 250%. Margins expanded a little bit again, but the valuation collapsed. It went back to where it was before. So the culprit in this example, in this period of weakness, in this inviolable formula, was valuation. Valuation contracted significantly, as likely as a result of behavioral bias, so a lack of willingness to pay that much anymore for that growth in earnings from Home Depot. And then, of course, the trend reaccelerates. So you can imagine through that checklist of trend change that we talked about earlier, how you were able to guide yourself into this position and out of this position and back in again based on that checklist of trend change. Strong relative performance, and guess what? Revenues continued just as strong as they were before, 242%. EBITDA, 268%. The margins expanded 100 basis points again, and the valuation went right back to where it was before. So the idea is, throughout this period, the company remained a phenomenal company from a growth and fundamental perspective. It was just undermined for a period by the valuation, all of which got translated, all the complexity of all those decisions that were made on the right side of the formula translated back into a simple one single unit price. But if used and followed appropriately using technical analysis and trend following techniques, was able to guide you in and out of this position to enable you to really capture, if you remember that earlier diagram, the sine wave, capture the meat of that trend that really everybody's trying to capture. And you can do that by combining all three of these inputs. So some additional examples of how we might find fundamental investors using this trend following. So top down, what kind of environment are we in? Is it bullish? Is it bearish? Is it mixed? Which sectors should I favor? What should I avoid? Which factors are leading? Which are lagging? And this is a really important question because ultimately the majority of what a stock does is determined by what happens in the market and the sector it's in. So if we take all the sectors in the market and we just simply rank them by their 12-month rank, which you see that as a technical score, and we go down that list and we realize that by the time we get to the middle of that list, the 12-month rank, the 12-month rate of change turns negative. That tells you that you're in a very mixed environment. So as a fundamental investor, you need to know that there's a lot of risk in this environment. Half the sectors in this market are actually down quite a bit over the past year. Half the ones of the sectors are up. So we know where to focus our attention in terms of our buys, what sectors to favor, what sectors to avoid. And then from a factor perspective, we can look at when we rank each of these factors by growth, profits, and valuation, what we can see here by ranking these various factors by their technical performance, we can see that what's working today is expensive, profitable growth. And so we, as a fundamental investor, that's where we want to concentrate our bets. So if we look at this table, we can see that that semiconductors are a leading sector. So here's that sector. And we can see during the COVID decline that the sector with everything else collapsed, but its relative performance actually hung in quite well. That's the market's way of telling you that when this is over, this should be a leadership sector. But lo and behold, that's exactly what happened. So semiconductors have been very strong throughout this whole thing. The reason is fundamentals. This is a very strong sector fundamentally, and that's the message of the market. So the way a diversified PM can use this information is if you were to rank each of the companies in the semiconductor space by that technical score, you can see that all of the stocks in this group, except for one, is outperforming the market. And that one stock actually has a negative return on the year. So in a year where half the groups are negative, within this specific group, only one stock is negative. That's telling you that the technical underpinnings, remember those trends that we talked about, the checklist of trend change, all of them but one have checked all the 4 boxes in the right direction. that's telling you, again, and if all these trends are being driven by fundamentals, it's telling you that from the bottom up, using technical analysis, we can get the sense that this is a very fundamentally strong group, which a generalist PM is going to want to know. If I'm a sector analyst and all I care about is the semiconductor stocks and I don't care about how they rank versus the market, I can rank technically each stock in my coverage according to each other. And so therefore you'll always have a best and a worst, and I'll know which stocks to focus on as an analyst within this space. So I want to be long these stocks and short these stocks. So even though a generalist would never want to be short these stocks, as a sector specialist, I would. And you can, through the power of technical analysis and trend following, you can glean these economic and fundamental messages by looking at the breadth of what's happening in a given sector. And once we're in that sector, you can see the difference in performance, right? So here's the #1 chip stock outperforming the market and outperforming the sector. So as a generalist PM, I'm going to want to own this. As a sector analyst, I'm going to want to own this. And then here's the worst company in the group. And the worst company in the group is actually kind of in line with the market. That's how strong the group is. The worst company is basically keeping pace with the market, but you can see it's underperforming the sector, the semiconductor space. So again, through trend following, we can quickly and easily distill where are the best fundamental trends vis-a-vis the price trend. And the same analysis plays through in the weakest sector. Here's energy underperforming the market. Here's the energy stocks. As a generalist PM, some observations I can make is that the best performing energy company is ranked 78 out of 100, with 100 being worst. This is the best one, right? All of the stocks in this group are down on the year. So this is a very weak group technically. And again, because we're talking about a long-term primary timeframe trend, this is telling you that the fundamentals in this sector are quite negative. If I'm a sector analyst, unfortunately, in the energy space, there are many of you perhaps on this call, you still have to make calls within this space. You can do that using technicals by ranking all the energy stocks relative to themselves rather than relative to the broader market. And what you find is there's plenty to buy in your space, and there's plenty to short in your space at all times. So when you go through that process in a weak group, what stocks to buy and what stocks to short, here's the best energy company underperforming the market, which we know, right? It's even the best one has a negative technical structure, but it's outperforming the sector. So a generalist PM, because it's underperforming the market, would not be interested in the stock, but a sector specialist would want to be interested in this stock. And then, of course, the worst stock in the group is underperforming the market and the sector. So nobody wants to touch the stock based on its underlying fundamental trends vis-a-vis the price. So this is how I've seen great PMs, fundamental investors, lean on these technical tools to become really, truly superior fundamental investors, portfolio managers by using the skills that they learn as technicians and technical analysts to really convey those tools and sort of adopt those tools into their portfolio management process to dig smaller holes, manage their risk, pick better stock selection, better concentrate their ideas in better sectors and things like that. So there's many ways that you can combine these three styles of investing into one to make you a better, more holistic investor. So hopefully that was helpful. I think we have some time left here. I'm available for the rest of the morning, so I can stick around for as many questions as there are. Anil, I'll let you take it away from here.
Sure, great, David. Thank you very much. I think it was a very engaging discussion. The slides were very interesting, and you had a very good approach of communicating. I think it was very engaging. Thanks a lot for that. We have a very good set of questions which have already come up, and I do also have a couple of questions from my side. I will try my best to incorporate as much as possible and raise various questions. In the meantime, I request friends from across the world who are still logged in, please do keep posting your questions. I can read them online in the Q&A tab. So any other questions which you feel have not got already covered, please do raise them. First question, David, very quickly. Very simple and very basic question which a couple of people have asked, and it was a question which I had also kept in my mind. If you can suggest some kind of a your favorite trend following indicators and connect it to that, maybe also as a kind of a hint or an input to some investors like me who are interested to learn a little bit more, if you can suggest, only any one good book for trend following.
So it's interesting. I teach a class, a technical analysis class at Brandeis University, and I actually begin with I think my very first slide is a slide that shows a price chart with all the different indicators that you could possibly use as a technician. And when you put them all on the chart, you can't actually see price because it just gets covered by all these indicators. And I think one of the great strengths, which I illustrated in our discussion just now, is the simplicity of technical analysis and the ability to succinctly determine what is going on in the market vis-a-vis something as simple as price. And I think that the further you go, the more tools you try to use to determine the direction of price, the more complex you can make it, right? So in the CMT body of knowledge, there are many indicators that you can use to help you gauge the health and power and strength of a trend, its timeliness and things like that. But what I would advocate is using just pick your favorites and lean more on those throughout the cycle. So for me, it's prices first and foremost, and then I use a series of moving averages, which we showed, the 50-day and the 200-day, and then relative performance, which you saw in most of those charts, is critical because in a very strong bull market, almost all stocks are going up. So you need to know which ones are going up the most, right? Because you can buy great looking charts and still underperform. So relative performance is very important. And then we didn't really get into it today because we weren't really talking specifically about technical analysis, just more about how to use it as a fundamental manager. But there are many momentum indicators, like we'll refer to them as RSI and stochastics, and which we refer to as MACD or moving average, convergence, divergence. And these are all second derivatives of price that can help you refine your timing, which are excellent. I use RSI quite a bit, and I use MACD quite a bit as well. So, but again, there are many different types of oscillators. They all basically signal the same thing. So what you don't want to do is you don't want to use Williams %R, stochastics, RSI, and then all these indicators that basically say the same thing. Just pick one and use that as an effort to learn more about it. You can of course the CNT body of knowledge. If you go to the website, there's more than enough information that available to learn about technicals. There's a book, actually, I have it here. So unfortunately, it's not readily in. I'll see if I can find it for you. But
we will email that with the deck when we send it to everybody. That's fine.
Yeah. Go ahead. If you have go ahead with your other question, and I'll see if I can find the book while you're asking the question.
That was very helpful. So basically, no doubt, one should keep it simple, not try to make too much of analytics and make it complex. Like RSI and MACD is one of the good indicators. I think one more thing before I go to the question. Vidhi, can you minimize this presentation, because I can see then David in very small box. So maybe then we can see David in a larger screen. If the presentation is removed, then the screen will be a little bit bigger, if possible. Otherwise, no problem.
Yes.
So you want me to? There we go.
David, next very interesting point, like you mentioned about the charts and some way of looking at the price movements. One of the slides you had shown, I think slide number 5, where you had mentioned about momentum and how you had mentioned it as one of the very important factors. So how, relating to momentum as a factor, would you think of when, let's say, there are certain inflection points when there is a change in the cycle and you are, let's say, following momentum as an important factor? What would happen? Because in certain positions, then it would significantly underperform, at certain points of inflection. So how do you see it in the context of this type of a market situation? And connecting that to another point is that, hence, what could, if at all, there is any such basic answer that whether there can be what could be a good time frame for using momentum as a factor?
That's the most critical question, actually, and I think it's not that there's a correct time frame to use for momentum. It's that you need to know what time frame you are using, because you can get shaken out of positions that would like if you're like for me, if I'm a primary trend investor, so I try to buy that long term. I look at monthly charts a lot. I look at weekly charts, and to me, when you think about Charles Dow, there's primary, secondary, and the minor trend. The minor trend to me is the daily time frame, and so I actually think the 200-day average is not really that long term of an average. To me, a 3-year moving average is a long term average. So when you actually look at the S&P 500 when we went through this COVID crisis, the S&P 500 on the daily chart, I think most people would agree, looked terrible, right? It was a very scary decline, and rightfully so. I mean, went crashing below the 200-day average. But if you step back and look at the monthly time frame, that primary time frame of trend, it went right down to that primary time frame trend support. So for me, it was critical for me to always be mindful of what time frame I'm operating in. And so if I looked at the daily chart, I would have been a whole lot more concerned about the long-term durability of the trend because that chart looked terrible. In that time frame, that checklist of trend change was about as negative as you could get. But the checklist of trend change on the monthly trend had not been broken. So the principles that we talk about, that checklist of trend change, you can use that checklist on the 5-minute chart, on the 60-minute chart, on the hourly chart. It's the same principle of inviolable. These things must happen for any time frame of trend to change. The more important thing is to be mindful of what time frame you're trying to capture. I stick to the primary trend because that's the one that's driven by fundamentals. The 5-minute chart, even though you can use that checklist on the 5-minute chart, is not driven by fundamentals. It's driven by noise and emotions, right? So it's the most important thing is to know your time frame.
Very important point. I completely agree, David. Yeah, and I think so for me in this whole session, David, I got 2 very important takeaways. One was this point which you just mentioned, that it's very important to know what is your time frame, and the other part, very interesting, was that in some form or fashion, you are a trend follower, even if you are a value investor. That was a very aspect that you tried to articulate, and in very beautiful way. It hit me very much when you showed that chart. So connecting that, one more very basic question is that, and it's very related to our title of today itself, that if you are an investor or an analyst who is using both technical as well as fundamental, what should be the order, whether it should be technical first or fundamental first? Or I'll put it in other context. Let's say if as a fundamental analyst or a fundamental investor, I could use some technical filters and let's say shortlist a particular universe and then do a further research in that. Or other way around, I have done my bottom-up stock-by-stock analysis, met the company management, got a comfort, and decided it with my team that yes, this is a stock I want to go with. And then I would look at some technical indicators like a MACD and try to see currently how the pricing is positioned, what volumes are happening, and whether it's a good time to enter or keep it slow. I mean, is there some right answer, whether technical first or fundamental? Just a particular thought which I would like to hear.
That's a really, really great question. And it gets back to what I talked about earlier in terms of looking at that formula, P equals G times V, is to know yourself as an investor and know where you should engage in that formula, because you're going to have to ride through that formula during the good times and the bad times, right? So for me, I'm predominantly a trend follower, but I recognize and respect fundamentals. So what I will do is I will use fundamentals to narrow my list to a group of companies that I would want to own, and then I would just watch them technically. If I'm a fundamental investor and I have to invest hundreds of hours on every stock that I'm going to look at fundamentally, what I would do is I would start the other way around. I would take technicals and I would eliminate one of the benefits of technicals. You can immediately get rid of half the universe. You can just get rid of the half of the universe that's underperforming, because there's no reason to own them. If you remember that sine wave, those are the ones that are in the bearish part of the cycle. Then you can also say, well, if it's underperforming, you can also get rid of all the bad charts. And by doing that, you can take a universe of 2,000 stocks, and depending on the environment, you can quickly narrow it down to maybe 500 stocks. And then you can say, we already know that these 5 sectors are really underperforming the market. So although there might be some good stocks in these sectors, I want to ignore those, because we know from the earlier discussion that most of what happens to a stock depends on what's happening in the market and what's happening in that sector. So you might be able to find a good stock in a bad sector, but it's like a fishing contest. If you want to win a fishing derby, you go to the pond where the fish are. You know, there might be one big fish in this pond, but if it's the only fish, there's no reason to fish there. Go to the pond where the fish are. So today you should be fishing in the semiconductor pond, not in the energy pond, right? So by using technicals to continuously narrow down a very large universe of potential stocks, now I have a much shorter list of names that I can then invest my very valuable limited time to do fundamental analysis.
Yeah,
yeah.
No, I think very good analogy, and that makes a lot of sense, that how you can optimally balance the two and make sure it comes up as a winning solution for your investment approach. So I think that's very, very good, point.
Right.
David, one more thing, which I would like to just take your feedback on. See, like you mentioned, very relevant point, that after this kind of a magic good balance of fundamental and technical, once you get set up your strategy, one very important element, and I can relate to it also very much, having been part of a risk management function earlier in my career, that it's very important to have a very robust risk process in place as well. Make sure you have certain stop loss and certain limits, etc., set in place. So, and in one of the slides, you also articulated how it's important to have certain points of, at certain checkpoints of stop loss. So just wanted to get your sense that if at certain point of time your investment style is out of flavor, should you wait it out and bear some kind of a underperformance or loss, or should you update your style or liquidate at that point of time and revisit the entire thing and then come back into the market? Or what, in your experience, whether it's like, whether it could be like, in a near term or a medium to long term, how do you see that kind of a balance between the risk management and your strategy not working in certain phase?
So another great question, and it's clear you've thought a lot about this. So what for me, as a pure trend following analyst, no matter how much I love a company, I'll sell it if I can check usually I'll sell it if I can check the first two boxes of a trend, of that trend change. If you think about the moving averages, those are lagging indicators. If you haven't gotten out by the time you get the latter two confirmations, which is the moving averages cross and the long-term average turns down, if you haven't gotten out by then, you should certainly be getting out then. Because for me, the only way a large loss can become a large loss is if it starts as a small loss. So I'm always of the mind that if for me, it's about that expectancy ratio. And if I'm going to be wrong 60% of the time, I must make sure that my losses are small. So for me, I'll sell immediately, and I'll get back in once I can check the list in the other direction. Now, I recognize that that's difficult for fundamental investors to do. That doesn't mean that you still can't respond. So where I've seen fundamental managers, so I'll go through a portfolio for a fundamental manager at Wellington, and I'll go through and I'll actually rank that portfolio manager's portfolio from a technical perspective. And what I would encourage them to do is, if the best stocks are up here and the worst stocks are down here, and there's a lot of large positions in the worst technical rank and a lot of small positions in the best technical rank, which is very common, usually because of valuation keeps it small and valuation makes it big, I encourage them to take capital at the bottom of the list and rotate it up to the top of the list. So you keep the same stocks, you're just taking less risk in those downtrending stocks. You can't lose sight of that. Remember that momentum chart that I showed you back to 1927? If you make it a practice of constantly owning stocks in the bottom decile of momentum, you are swimming upstream, right? So if you have a portfolio that looks, and there's a lot of stocks in that bottom decile, they're dragging on your portfolio. If your fundamental investment process gets you there and you have to own them because you have no choice, it's how you invest, that's fine. Just don't make it a top position. Just make it a place setter. Make it a 50 basis point position, and try to make the ones that are in that top decile of momentum, top 3 deciles of momentum, make those your bigger positions, because those are the ones that have the better chance to be that outlier on the right side of your return frequency.
Sure. Yeah, makes sense. Yeah, I completely understand your point. David, I would like to, there are many questions which have come up which are relating to current market, current valuations, specific sectors, etc. Some of them I will like to steer clear, keeping in mind certain compliance restriction, etc., not to go into market views or expressing forecast on markets, but I would like to summarize it in one broader context, if it makes sense, that let's say if you look at the current markets, whether in broader, let's say equity markets, let's say the US market, for example, where we feel that in these last couple of months, it has seen a very sharp rally, maybe a little bit delinking itself from fundamentals. So because of that, might be, if you look at, let's say today, US market, it might be roughly about 150% market cap to GDP, or let's say the sharpness of the rally itself is slightly delinked from the fundamentals. So in this type of a situation, how do you see the connectivity between, again, fundamental and technicals, and whether it is certain times one or two specific sectors where you see historically has been a much more wider divergence in terms of the gap between fundamental and technical, or do you see it as a more broader market kind of a phenomenon?
Yeah, I think one of the things I do hear a lot today is this belief that the market is disconnected from the fundamentals, and I can see why that would be the case. The Nasdaq is out to record highs, the S&P is up 50% off its bottom, and that all seems like, how can that possibly be if we're experiencing one of the greatest economic collapses in history, right? I would make the case, though, that when you do, as we did in that exercise earlier on, if you do drill beneath the surface of the market, you find that there's actually quite a connection between the fundamentals and what's happening in the market. For 10 years now, what's been working is growth. Growth has by far been the best technical trend, sort of trend condition in the market for 10 years. And when it first started to turn, it was not quite clear why, but now we've come to realize that there's no growth in the world, and so therefore growth stocks have been leadership for that period of time. I think you can make the case that what happened in COVID with this virus only exacerbated the trends that were already in place beforehand. So if you thought there was no growth before COVID, where do you see it now, right? So now what's really working today is, if you look at the growth versus value relationship, the trend, again, which reflects the fundamentals, has gone nearly vertical. And so the net effect of that, though, is that the growth names that are working, they're not just large caps, they're mega caps. These are very large growth companies: Amazon, Alibaba, Tencent, Microsoft, Adobe. These are very big companies, right? And because they're large, not just large, but they're outsized, and these are market cap weighted indices, it pulls the index up, giving it the impression of a very strong bull market. But as I showed you, if you measure the trend condition of that checklist of trend change, if you measure every stock in the market vis-a-vis that process, you find that half the market is not only down, it's down a lot. And then when you look at what's down, it's all those companies in sectors and regions that are very cyclically dependent. So when you actually look beneath the surface, what's happening in the market, forget about the index, because the index is lying, right? The index is being overwhelmed by these mega caps. Dig beneath the surface and you find that the majority of what's actually tied to the economy is doing very poorly. So the economic message that's emanating from this technical process, from this bottom-up, one stock at a time process, I would argue is very linked to what's happening in the economy. And then you layer in this record stimulus from the Fed, and nowhere for that money to go. It ends up going into these companies that are leading and that are benefiting the most from this, the stay-at-home trends, which is again those mega cap growth companies. I think what's happening in the market is almost a perfect reflection of what's happening economically. There's a lot more. In other words, there's a lot more to the market than what you see than what you see on the surface. It's all taking place beneath the surface. I showed you the energy sector. The best stock in that sector is got a rank of 79, with 1 being the best. Every single stock in that sector is down. So that's a pretty good reflection of what's happening fundamentally. Every semiconductor stock is up. That divergence between the two is because there's no growth in the world. If you just check your own opinion at the door in terms of what you think is happening in the world and just listen to the message of the market, you realize that what the market is saying is a perfect reflection of what's happening economically.
Sure. Yeah. David, I think we are completely out of time because our slot was an hour. I have taken the liberty to take about almost 20 minutes more of your time. So I'm going to conclude with 2 points. Point number one, once again, it was really great to have you here, David. Thank you very much for your wonderful insights. And the second point, just as a concluding thing from my side, as a key takeaway, as a learning from my side, I feel that it was very engaging to try to reiterate the focus which one should always have as an investor, that at certain points of time in certain markets, it's very crucial that you always keep in mind the technical aspects. It will result into a much more better and a robust investment framework for you, irrespective of whether you are a value investor or a growth investor, or you are a quant manager where you are trying to apply certain rules and codify them and take away certain human biases. It's very, very important how you can interlink and merge both fundamental as well as technical in the right mix and right balance, as David just articulated to us. So with that, friends, thank you all. Really appreciate you joining this session. This was a wonderful initiative from both CFA Society India as well as from the CMT Association. So I would like to take this opportunity to thank everyone for that as well. Plus, this was like a global passport event. So many other CFA societies across the other parts of the world also had expressed interest, and many of their members are on the line. So I thank all of you. I hope it was an engaging session. David, once again, thank you very much, and signing off from the session. We'll look forward to connecting. Okay, friends.
Thanks very much, Anil.